kept secret, though, that all three of us have birthdays.
Ah, I know.
So you too, Mrs. Ritter, are getting older. So welcome to our webinar talking about August production, October webinar. So this is the month that we've all been anticipating, but we're definitely not looking forward to. 49,000 barrel a day drop in production, and for the first time since March, I believe, of 2014, we are below 1 million barrels of oil a day. And so that's not great news, but we've all been anticipating it. It's a 5% drop in oil production, 3.5% drop in natural gas production. I have compared looking at the revenue forecast that the state is working from right now. Our production is still just slightly above revenue forecast, about 5% above, and price is about 8% above revenue forecast. So we're tracking very well with the revenue forecast and with expectations, but we've all been wondering when this month was going to come. Talking about momentum this month, and that's the theme for the month. Momentum in engineering terms is mass times velocity, and the Bakken is massive. It is really, really big, and when something like that is moving very, very fast, like it was in 2014, it takes a long time to slow down. And it is continuing to slow, and we still expect that we will bottom around 900,000 barrels a day. So there's still more slowing to come over the next few months, based on what we're seeing in the number of completions and the lack of drilling activity out in the oil field. It will also be a long process to bring it back up to speed. And so anticipation is that it will take a significant amount of time to get back above 1 million barrels a day and back to activity levels, even activity levels that will sustain or grow production. Along those lines, the question, of course, the big question is, will OPEC be able to adopt the production cuts that they've been discussing and talking about in the media? And there's already some dissension in the ranks starting to appear, and some concern that Libya, Nigeria, and Iran might spoil the deal. So industry is not going to jump out and start hydraulic fracturing wells right away just because we got above $50 for a few days. They're going to take a wait-and-see approach, and of course that OPEC meeting will be right around Thanksgiving time. So we'll have a much better idea when we do our December webinar as to how firm that price increase is going to be. On the flaring side, we lost a little bit of ground. We did actually see the flaring volume go up slightly. I believe the flaring volume went up, let me look at my sheet here. I got several, and I have shuffled them. My apologies. I have it going up 6.5 million per day. The flaring percentage is up to 11.4%. The good news there is that the Bear Creek plant is now running gas, and it's at about 50% of capacity. And along with that, there is another small plant called the County Line plant up by Tioga that Liberty Midstream has brought online, and it is also taking gas and expects to be up to maybe 15 million cubic feet a day by the end of the year. So there's not any great deal of concern about not meeting the, I hate those double negatives. We're not terribly concerned that we're going to be unable to achieve the gas capture goals. We still think the 88% goal that takes effect the 1st of November, 1st of next month, is solid, and that industry will be able to reach that gas capture goal. And then lastly, on the federal front, the big item that's in process right now is that EPA has published the second draft of its information request, and we have 30 days to comment on that. I've been looking for it in the Federal Register. EPA thought it was going to be published last week, but I haven't seen it in the Federal Register yet. I anticipate that the Industrial Commission is going to be making comments on that. EPA says they've made substantial changes to decrease the burden on industry. I printed the documents and I haven't had a chance to really review them, but we'll be discussing that at probably the November Industrial Commission meeting, looking at comments on that. That is our report. I will just mention, as far as the production drop, we saw production fall in every single county except Golden Valley, and substantial production decrease in the core counties, the 4 big counties. And so only Golden Valley had a slight production increase. Every other county saw production fall for the month of August.
Okay, the big question is, what's the significance of going below 1 million barrels a day? Does this lessen North Dakota's role in the global oil market?
So I think you have to answer that as far as somewhat yes, from the standpoint that, as you heard Jack Stark say last week or the week before, we're really now the swing producer in the world, and so our oil and gas operators are responding to the global price signals that the world markets are sending. And I think it's more of a psychological thing than it is an actual physical thing in terms of state revenues or actual physical impact on the global markets or even U.S. storage. But it does send a signal to the world markets that U.S. producers are serious about reducing activity, reducing costs, reducing production, and I think that should help to support the recent price increase that we saw.
Is 900,000 barrels a day still the bottom, and when will that be reached, do you think?
We are still anticipating 900,000 barrels a day as the bottom, and we're looking at that, I think, as a June or July of 2017 number. So we're, with this number, that means that we're about 9 to 10 months out of reaching the bottom. So we anticipate over the next 9 to 10 months continued production drops. There may be some months where it increases, depending on what folks are doing with completions or that sort of thing, or if they've been restricting production in an area in order to achieve gas capture. But with that new gas capture goal, that actually is going to affect what operators can do. And until Bear Creek is up and fully running, Dunn County is going to be restricted in terms of activity.
As a historical perspective, when did North Dakota actually reach 1 million barrels? Do you remember?
The question was, when did North Dakota actually reach 1 million barrels a day? And if I recall, it was March of 2014. We'll correct that if I'm wrong. I know it was just shortly before we had the Million Thanks celebration up in Tioga, and there was some worry or concern about whether we would actually get there. So it was either February or March of 2014.
And what prompted such a sharp drop that month? We would be expecting such a significant drop in summer months, and also, I guess, why did flaring spike when it was production decrease?
Two good questions. So the first one was, why such a large production drop? Because typically we've been seeing 10 or 20,000 barrel a day production drops, and that's what we have built into the revenue forecast. So with last month's increase and this month's drop, we're actually right on track. Anecdotally, I have been told that a number of operators actually restricted production in August, that the weak prices and the long-term outlook for the market made them resistant to want to produce their oil at the low prices that we were seeing in August. As you know, August and September prices were down. And so we actually had at least 2 operators that anecdotally said they shut some wells in for part of the month and actually restricted production. So it wasn't just a natural decline of wells or a reduction in well completions, but actual intentional reduction of production in order to maintain their assets and not liquidate at low prices. As far as gas production, we took a look at flaring, and two counties are below average. Dunn County, which should be resolved by the Bear Creek plant, and Divide County. There's a lot of stranded gas in Divide County, and it's going to be a much more long-term difficult project, but the real increase in flared volume is in Dunn County, and Bear Creek should resolve that.
Okay. I was going to mention, the last time we were below 1 million barrels a day was indeed March of 2014. We hit just over 1 million barrels a day in April of 2014. Okay, next question. Do you think operators will circle the wagon, so to speak, in the months ahead and drill more in McKenzie County?
I actually am seeing, and I found this interesting when I looked at the month-to-month rig counts, that for the first time ever, Dunn County is ahead of McKenzie County. So what I am hearing from the operators is that the results that they're getting in northwestern Dunn County are better than any place else in terms of well productivity and completion costs. And with the Bear Creek plant coming on, they expect to hit that area very hard and fill that plant. So actually expect northwest Dunn County to be the most active area for the next 3, 4, 5 months.
So the million barrels, just one more question. So that's at this point more of a psychological thing and not necessarily an indicator of long-term health?
Yeah, so the question was the 1 million barrels a day and falling below it, is it an indicator of long-term health problems or more of a psychological thing? And I think the impact on the market and the impact on North Dakotans is more psychological. Long-term health-wise, I have actually completed the analysis that the EDTC committee asked me to do, which is lower for longer, that, how long does it take at current rig count to completely exhaust the core area in which then we really damage our long-term future. Under that scenario, it takes more than 10 years for the current rig count to exhaust all the drilling prospects in the core area. So it's highly unlikely. And even under that scenario, if we spend 10 years at this rig count and we exhaust the core, we still have the economics and the oil in place to drill 55,000 wells. So we do lose ultimately about 10,000 wells from the ultimate well count for all time. But the Bakken is still very healthy, and most of the good years are yet to come. But it is, to the market, it's going to make a difference to have a 50,000 barrel a day drop in North Dakota from July to August. And one of the reports that I follow substantially showed that this month the people selling short contracts versus long contracts has flipped to where there's now twice as many of the speculators who are betting long on oil price increases as there are folks betting short. So the market is really seeing the fundamental supply-demand come into balance. And we're in a process now of working off the storage around the world.
Why has it taken so long to drop below 1 million barrels a day? What kept production above that until now, and what changed?
So, again, getting back to the theme of momentum, that's really why it took so long, is that this was an enormous play with lots and lots of non-completed wells and still 30 to 35 drilling rigs operating. And it took a very long time for something like that to slow down to below 1 million barrels a day. What we think really changed between July and August, and why we saw this big drop, is the anecdotal information that we have that 2 or more operators actually purposely were restricting production because they were seeing the July to August to September price declines, and saw potentially that we could end up back in the 20s in North Dakota, and they did not want to liquidate crude oil at less than $30 a barrel. So they actually physically shut wells in or restricted production, and that changed everything from July to August.
Anybody in the coverage room?
I know Western crude went to like 50s last week. Do you expect it to sustain the time period needed for people to start drilling again?
Yeah, so the question was, with the plus $50 West Texas Intermediate price of last week, do we think that this time it's going to sustain the 90 days to build confidence? And we do. The sense is that this is different than the little price spike that we saw back in May. Some of those things that we saw over the May, June, July timeframe were OPEC members testing the response to announced production agreements or production cuts. And leading up to this most recent announcement, they had announced, well, we think we've got a deal to stabilize production, and oil price jumped 4 to 5%. And then they came out a few days later and announced, well, maybe the deal was falling apart, and oil prices fell 4 to 5%. And those were market testing maneuvers on their part. At this point, the major worldwide oil producers, BP, ExxonMobil, all those guys, say that we are at balance, supply and demand, and that by the middle of next year, the world is actually going to be in short supply by as much as 500,000 barrels a day. And so we are beginning at this point, or from here through the end of this year, to erode the crude oil storage inventories around the world. So being at balance is a very different situation than what we had in May when we were still in overproduction. And so this does appear like it's going to be one of those solid price increases that lasts for the 90 days that's needed to build confidence.
How do you think that OPEC decision really affects North Dakota's state production?
Well, I think what it does is it changes the momentum of the business such that we do, in fact, stay above 900,000 barrels a day, and we are able to, our industry is able to begin in rebuilding production sometime in the second half of 17, certainly in the first half of 2018. So I think it helps us set a floor and a bottom to this thing, and it gets a little more predictable. The other thing that it does is, and I was in a conversation with our revenue forecasting people from Moody's, and basically everything they're seeing is that all the risk is now to the upside in terms of the revenue forecast. So that's exactly what it does, is it places all of the risk of estimating revenue to be positive, that it'll be higher than the revenue forecast if it's off at all.
The Bakken seems to be losing momentum, like we talked about. At the same time, it seems like the Permian Shale Basin is attracting more interest from operators. Is there a reason for that, you think?
There is, and interestingly, I was in a meeting with the chair of the Texas Railroad Commission yesterday, and we talked about the Permian and some of the work that's going on down there. The Permian is very new in terms of industry's understanding of it, and a lot of capital has been shifted to the Permian by even Bakken operators purchasing companies like Yates Petroleum or large acreage positions down there. And so the Eagle Ford is even more losing momentum than the Bakken. But the Permian has maintained or is actually increasing in terms of capital investment. So it's going to be a major competitor in terms of WTI oil markets.
Okay.
Always has been, though.
Yeah.
The Permian has always been one of the premier world oil producing basins.
Okay, I have a double check sort of question, and again, I tell people I read, so I don't always get to hear. Can you go back to what you said about flaring reduction targets? Somebody thought they heard you say that they're unattainable.
No, and that's where I got wrapped up in my double and triple negatives. We're confident that industry is going to be able to attain the 88% capture that kicks in November 1. They're very close to that, and now, as I said, Bear Creek is taking gas and should be at 100% in November. And this other small plant called the County Line Plant up northwest of Tioga that Liberty Midstream has brought on should be processing 10 to 15 million a day by the end of the year. So we're very confident that the 88% is attainable.
Is the Bakken increasingly at a disadvantage to the Permian or the Eagle Ford on a relative economic basis in terms of geographic access to markets?
And the answer to that has to be yes. We have seen the differential of WTI to North Dakota expand again from, at one point I think it had gotten down to around $2 per barrel, and it's back in the $8+ range. And so we are further from the market, and we suffer from a transportation differential, a transportation basis that we'll never be able to completely eliminate. But as you know, there's people that want to invest money to reduce that.
Okay, that is all I see. One more, and we will address this, and this will be the last question. Will North Dakota production be affected at all if completion of the Dakota Access Pipeline is delayed? Will that affect production?
I think it's built into the forecast that we have, meaning that I don't see it causing production to go lower than the 900,000 barrels a day, but it does have the potential to hold us at those low levels longer. Because with the added transportation differential, that makes other basins more attractive, like the Permian, and could certainly shift capital to the Permian from the Bakken because of that price differential. And it means that, you know, maybe instead of $60 a barrel being the point where the Bakken is more economically attractive, it's got to be $65 a barrel. So yeah, I think in the longer term it could affect production. In the near term, we're still going to decline until the middle of next year. But in the longer term, we might stay at those low levels longer.
Okay, Mr. Kringstad, you're up. Yo, you didn't see those there?
No, I didn't see that. Those.
Hide them? Is it on?
1 second here now.
I thought you turned it on.
That should be.
There we go. Alrighty, you're up, JK.
Excellent. Well, good morning, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. Just get right into some of the updates. First, on slide 2, production, neighboring states. Again, just slight decreases. Nothing on the horizon. Change that, in my opinion. Right now, there are 0 rigs active in eastern Montana, 0 rigs active in South Dakota. So the expectation is that not only with North Dakota's continued production slides, expecting the same from neighboring states, they have less production coming into the transportation system then for movement out of the region. On slide 3, not a large change. Not a lot has changed on the overall scheme month over month, but just an update on how the oil is estimated to be moving out of the region. Again, pipeline continues to dominate in the current market conditions. Again, I'll touch on that here in another slide or two, what the market's been doing. On slide 4, you can see, again, no major changes with the market share of pipe versus rail. That dotted blue line, which is the spread between Brent and WTI, that continues to stay less than that $2 to $3, which continues to make the pipeline options out of North Dakota be the more attractive option for barrels that may not already be committed to one of the two systems. Slide 5, just an update on the estimated rail volumes. We're still hovering right around that 300,000 barrels a day estimated to be leaving by rail. Slide 6, a little bit of a shift on where those barrels are estimated to be moving to. We've seen prices tick up a little bit on the East Coast versus the West Coast, and you can see that reflected in the chart on slide 6, where we're, instead of being on par with each other, we're seeing more barrels heading to the East Coast versus the West Coast. On slide 7, just pricing from around the country. Again, you can see the East Coast, that PAD 1 region, being the highest priced market. You can see on the far West Coast, then PAD 5, a little bit less than PAD 1. So again, if you're that barrel that has the flexibility to leave North Dakota and choosing which market to go to, you're obviously going to try and find the highest priced market to get there with the lowest transportation costs. And in the market over the summer, PAD 1 was appearing to be the more attractive rail option. Taking a look at prices today, still less than a $2 spread between Brent and WTI. So again, that tells me that in the near term, I don't see any major shifts. I don't see any major shifts back to rail. I don't see any major shifts away from what we've been seeing here over the last several months. When we take a look at truck movements across the border, north and south, again, back down to some of those normal levels. We had seen that spike up earlier in the year, but back down to some of the more, what I would consider normal levels of movement between North Dakota and the Canadian side of the Williston Basin. On the flaring, as you heard from Lynn, back up to 11%. The increase was in the orange piece of the pie, which is flaring from wells that are connected. We've not seen any movement in that blue piece. So 2% of flaring, or 2% of the total gas production is flaring, again, because it does not have a well connection by a pipeline system. The 9%, that's where we saw the increase. Again, flaring from wells that do have a pipeline connection, but for one reason or another, the system was not able to handle all the gas coming out of the producing regions. And as you can see historically how that has evolved. And so again, right at the far right-hand side, that slight uptick in the orange piece of connected wells. And slide 12, this is, again, how we try and judge how quickly wells are getting connected and how well the gas gathering systems are doing. You'll see that a little bit of a shift. We saw that new producing wells for the first time in recent history has outpaced the new wells selling gas. So this is something to keep an eye on, whether or not what was taking place, whether or not we'll see this shift here in the coming months, or if this is going to be a longer-term trend that the midstream industry is going to have to get ahead of again. But again, as prices start to recover, as more and more wells start to go into completion, the midstream industry then have to continue to stay active, making sure that those wells are getting connected as quickly as operators are ready to bring them online. And then moving forward a couple slides, just an update on natural gas liquids production. We saw a slight decrease in the month of July, which is the most recent. But again, the overall trend is that this is going to continue to rise, especially with new gas plants coming online. As gas capture increases and as gas production increases, these natural gas liquids being produced in North Dakota are going to continue to increase. And so, again, going forward, I'm hoping in these press events to have a little bit more color available as far as how these natural gas liquids are moving, so we can keep that on everyone's radar, especially what's happening on that portion of the industry. So with that, I'd be glad to answer any questions.
That a little more color is appropriate use of words, because that slide is very colorless. There's no color on it. anything from the conference room?
Overall, I've seen, build out infrastructure for natural gas, does that overall still stay pretty strong, despite the kind of slowdown in general, or things that have been?
Repeat the question.
That spike recently, but, overall, company's still building out pretty solid, mature infrastructure.
Correct. So the question was, on the midstream gas gathering sector, what's taking place? Are they keeping up with development? Has it slowed down? Has it increased? So on slide 12, I'll just quickly reference that. So new wells selling gas, which is the black line, you can see that the number of wells getting connected has gone down since activity slowed down. And so midstream companies right now that I work with, they are gearing themselves for the return of activity. So they're starting to make sure that systems are being designed and enhanced. They're trying to do all the groundwork now so that when activity does start to return, they'll be able to more quickly address growing volumes from other parts of North Dakota. So they've not sit idle. The number of well connections has gone down, but overall they've been very active trying to gear up for what's ahead.
How well prepared would you say they'd be for whenever things eventually rebuild, momentum kicks back in again? Or are they better positioned than what we had maybe 2, 3, 4 years ago?
And so the question is, are they better positioned now? I would say absolutely. The understanding of how the wells are performing, there's more understanding now of how many wells are going to be drilled on each pad location. That was always a challenge for the gas gathering industry. Was they may have built a system for 1 or 2 wells, and then a couple of years ago it shifted to 4 to 8 wells, and now we're looking at significantly more wells than that. And so it's always been a game of catch-up. But I think right now the understanding of play, the understanding of what to expect on these locations is at a much higher level than it was in the past.
Silent on the webinar, silent in the conference room. I will take that as a sign that we are done. So, sure. So, thank you, everyone.
Sing a couple lines.